Payment shock coming for most Canadians with mortgages. About 60% of mortgages will be up for renewal and higher payments according to RBC. Variable rate mortgagors are expected to see significant payment shocks, perhaps as high as 84% if rates do not decline. In this video, I'll break down the stats and the health of the Toronto real estate market, and make sure to watch till the end where I talk about what could possibly save the market from crashing. Hello, my name is Sitzer from Team Sir Real Estate. If you're new to this channel, please consider subscribing for all things real estate. To book a one-on-one call with me, please go ahead and click the link in the description to go to my calendar page to choose a date and time that works best for you. Now, according to a report from RBC Capital Markets, the outstanding mortgages set to renew between now and 2026 are worth over $900 billion. By 2026, $400 billion worth of mortgages are set to renew, a figure that includes a large proportion of so-called negatively amortizing loans. The increase in monthly payments could be as high as 48% on a weighted average basis. The report also says that in 2024, Canadians can expect payment shocks of 32% when more than $186 billion in mortgages are set to renew, and 33% in 2025, when about $315 billion of home loans will come up for renewal. But the mortgages renewing in 2026 is likely to face the biggest challenge. That's when a significant portion of variable rate mortgages with fixed monthly payments are set to renew. Now, those borrowers have continued to make the same monthly payments as interest rates have gone up, but in many cases are now paying only interest in each month, extending the length of time it would take them to pay off the loans, also known as negatively amortizing. Now, when they renew, they will face much higher monthly payments. Variable rate mortgages are set to see significant payment shock, perhaps as high as 84% by 2026 if rates do not decline. So, what about defaults and delinquencies? According to President and CEO of the CMHC, Romy Bowers, there are presently around 6,000 households with highest risk mortgages given today's interest rate realities, translating to roughly about 2% of all mortgages insured by CMHC. She also mentions that while those 6,000 some households are at the greatest risk of loss, she also said that she doesn't believe the country is in for a wave of mortgage defaults. However, a large spike in unemployment could change that. She goes on to say our arrears are at historic lows, and as long as the employment picture is strong, we do not anticipate defaults. Now, Bowers additionally stated that the number of Canadian mortgages in arrears is now at 0.25%. That figure is down from 0.5% in December of 2022, so they're now at historic lows. A lot of banks are offering extended amortizations, an option that is now being offered quite commonly by lenders. So, what needs to happen for Canadians to not have a huge spike in payments and defaults? According to RBC's report, if the Bank of Canada's overnight rate, which is now at 5%, comes down by 100 basis points, that would reduce payment shocks in 2024 and 2025 to about 22% or 23%. To reduce payment shock to 20% for the entire variable rate mortgagors, the Bank of Canada's overnight rate would need to fall to 0.25% by July 2026, which is perhaps an unreasonable expectation at the moment. Now, the rise in interest rates is also quite apparent in the real estate market based on the numbers that just came out for October of 2023. Sales are at a 25-year low. In October of 2023, we saw 4,646 sales. Active listings about 19,540. The average price stayed at about $1,125,000, which was about a 3.5% year-over-year increase. Now, I'm not too shocked with the year-over-year increase of 3.5% from the peak of past May. The numbers which we're going to get into in a second were still quite low. However, strong and resilient housing demand has kept the housing market and prices quite strong and resilient up to this point. As we saw CMHC's CEO talk about earlier, arrears are at a historic low. So we're not really seeing a ton of defaults or motivated sellers come out into the market just yet, but that may change later down the line, especially if unemployment starts to rise. Let's look at the property types and what those numbers are. Detached sales dropped about 5.7% year over year. So did semi-detached and townhouses from 3.2% and 2.2%. The biggest difference, however, was in the townhouse property type that took a hit of 11.5% in sales year over year. However, when it comes to the average prices, detached is up about 6%, and semi and townhouse about 2.1% and 1.1%, and condos taking a slight dip at 1.2%. Now, I want to take a second to look at the year-to-date numbers because that's where I'm seeing a lot of interesting data. So I track this every single month when the data comes out, and starting in January, obviously, it was a slow year. Percentage price change month over month from December of 2022 was just over 1%, and then it started to tick upwards February, March, April, and May into the spring market. May is when we had the absolute peak at 1,196,000, and since May of this year, we have slightly tracked down in pricing, about 5.87% drop in October numbers since May of this year. However, the number that I really want to focus on is the MOI, or the months of inventory as we call it, which talks about the absorption rate, or if no new listings were to come to the market, it would take over 4 months to sell all of the existing inventory, which is quite concerning because it's taken us closer and closer towards a buyer's market. As you can see, throughout the beginning of this year up till now, we were in a pretty heavy seller's market, and now we're at a much higher balanced market. So obviously inventory is up, active listings are up, sales are down, translating to higher months of inventory. Now, how does this October compare to the previous Octobers for the last 5 or 6 years? Again, as you can see, based on the last 5 or 6 years, our months of inventory is still quite high. Active listings extremely high, and our sales to new listings ratio is just about 32.3%, which is actually lower than last fall's numbers. So with all this data aside, here's where I think a lot of buyers are taking advantage of now. Whether you feel this is the right time to buy or sell completely comes down to your circumstances. But what I'm seeing a lot of buyers that I'm working with do right now is they are more so looking at whether or not they can actually make their payments every single month and afford a higher mortgage because they're seeing a big discount in the purchase price. See, when rates start coming down, a lot of buyers are going to flock back into the market. The demand hasn't gone anywhere. The demand is still there, but it's just in the sidelines because a lot of buyers are right now uncertain. So a lot of savvy buyers right now are really going out into the market and taking a pick and really taking their time to look at the type of property they really want to buy. They're looking at the monthly payments. They're able to negotiate all the terms and conditions. They're not married to the rate, because the rate can, again, change in the future. They can always refinance. However, they are taking quite a discount when it comes to the purchase price. So whether this is a good time to buy, again, completely comes down to your scenario, whether you have a property to sell, whether you're looking to upsize, whether you're a first-time buyer, and what your finances look like, what property type you're looking to buy. So again, if you are wanting to know what your specific situation looks like, feel free to click the link in the description to book a one-on-one, no obligation time with me so we can figure out together whether or not this is the right time to buy or sell. Once again, guys, thank you so much for watching this video. If you did, please go ahead and give it a thumbs up. And of course, don't forget to subscribe. I'll see you guys in the next video.